Think a 10% yield is a guaranteed win? Think again. Today we're exposing two huge myths that could be costing you serious money. We're talking about why chasing yield can be a trap and why sticking with the US market might not be the smartest move. Let's be real. We all love the idea of getting fat returns. But what if I told you that sometimes the juiciest yields are the most dangerous? And what if the safe bet of the US market is actually riskier than you think? Stick around, because we're about to uncover some uncomfortable truths. Let's start with the myth of yield. A high yield can feel like hitting the jackpot, but often it's more like a siren song, luring you onto the rocks. Companies offering sky-high yields are often in trouble. They're like that friend who always promises to pay you back, but never does. They might offer a 10% yield, but if they go bankrupt, you get nothing. This is the fool's yield trap. It's tempting, but it can blow up your portfolio. Think about it. If a company is offering a way higher yield than everyone else, there's probably a reason. It's often because they're desperate for cash, and investors are demanding a higher return for the increased risk. Don't fall for it. Stick with investment-grade bonds. They might not be as flashy, but they're much less likely to default. The same principle applies to private credit. Just because someone dangles a high yield in front of you doesn't mean it's a good deal. Do your homework, and don't be seduced by empty promises. Now, let's talk about the great rotation myth. For years, the US market has been the king of the hill. But lately, it's starting to look like a wobbly king. Valuations are stretched, and the market is concentrated in a handful of mega-cap stocks. Meanwhile, international markets are on sale. They're like that hidden gem in a thrift store that everyone else overlooks. Historically, cheaper markets have delivered better returns over the long run. So, while everyone's piling into the expensive US market, contrarian investors are quietly scooping up bargains overseas. Think of it like this. You wouldn't pay full price for a burger when you can get the same burger for half the price across the street, would you? International markets offer similar potential for value. Now, I'm not saying you should dump all your US stocks, but diversifying internationally can help you reduce risk and potentially boost your returns. It's like having a backup generator. If the power goes out in one place, you've still got another source of energy. The problem is, most investors are creatures of habit. They follow the crowd, chasing the latest trends and ignoring the less obvious opportunities. They see a high yield and think, cha-ching. They see the US market's past performance and think, can't go wrong. But this kind of thinking can lead to disaster. It's like driving with your eyes closed. You might be fine for a while, but eventually you're going to crash. So how do you break free from this herd mentality? It starts with questioning assumptions. Don't just blindly accept what everyone else is saying. Look for the cracks in the narrative. Ask yourself, what am I missing? Think critically about yields. Are they sustainable? Are they compensating you for the risk? Think critically about the US market's dominance. Is it justified? Are there better values elsewhere? The key takeaway here is to be a thinking investor. Don't just follow the crowd. Do your own research. Consider alternative perspectives, and don't be afraid to go against the grain. By understanding these principles, you can avoid the yield trap and the great rotation myth. You can find real value in the market and position yourself for long-term